Welcome to the Spotlight on Digital Lending Insurance. I'm Chris Geil, Director of Lending. Today we're going to be talking about Payment Guard. Before we get into Payment Guard, I wanted to put a little preface on how Payment Guard came to be. It was all about the digital shift, right? And I'm sure you've all seen a plethora of forecasts and projections out there on the digital shift. But I put a couple here on the screen that I saw recently, McKinsey's research, particularly around revenues from fintechs and the market size and the expected growth year over year of about 25%. I'll finish with digital adoption is no longer a question, but a reality. And it says around 73% of the world's interactions with banks now take place through digital channels. I think there's no denying the trend towards digital. Today, we know a vast majority of even lending starts online with applications. We're seeing significant growth in auto approvals with the technology and the AI. And we're even seeing solid growth in auto funding. Now, of course, this varies by loan classes. Some are migrating quicker than others. You think credit cards, right? I think it started with credit cards. And a lot of credit unions now are doing it in personal loans or even micro loans. So we're seeing quite the expansion in those particular asset classes. So what's holding us back? I think fraud is holding back a little bit of the digital shift, the talent, the resources. But there's no doubt this trend will continue. Why? Well, I think the digital shift has primary focus is the consumer experience. The consumer demands it. It's the expectation nowadays in consumer lending. And then, of course, we've got the efficiency play internally. Consumer margins are tight. We need to work on expense ratios and acquisition costs of those consumer loans. And digital channels is certainly one of the ways to achieve that. And then the access and growth. To get access to those consumers, we can no longer wait for them to come into our financial institutions. We've got to go to where the members are, where they're looking for the loans or the funds. And that's point of sale, embedded, but all of this will take multi-channel, we know, for a while. And then, of course, expanding access to credit, access to credit to a broader market, or even deeper into the credit bureaus, if you will, for some of our members. We're all in the risk business, right? Payment insurance has proved it plays an important role as an economical risk mitigation tool for lenders and members. The insurance protections help enhance the resilience of lending portfolios and protects members and consumers from certain unexpected events without derailing their financial stability. Traditional payment insurance has played an important role in credit unions for decades. It was originally built to be offered by finance experts, or the lending staff, if you will. With these digital shifts, there is a recognition that simpler solutions are needed to position these valuable protections. All of this led us to develop a first-of-its-kind digital lending insurance, Payment Guard. I'll turn it over now to Danielle Sesko, Director of Product Management, and one of two TruStage finalists for the Women in Consumer Finance Uplift Awards in 2024. Danielle?
Thank you, Chris. So as Chris has mentioned, consumers have really voted with their mobile devices or keyboards over the years that they just not only expect, but they demand a digital lending experience. And there have been a plethora of fintechs and digital lending solutions that have stepped up to the plate over the years to fill that gap. And at TruStage, we responded by building the first of its kind digitally native insurance product. We built this product based off of the demand from what we heard from credit unions, from fintechs, and from borrowers alike, that they wanted protection for those loans. Consumers are concerned about defaulting on their loan payments. In fact, about 8 out of 10 have that concern. So we responded at TruStage with the first of its kind digitally native insurance product, Payment Guard. And Payment Guard is a portfolio protection solution. It was the recipient of the Celent Award last year as a finalist for the Finovate Award. And it's built to build a more resilient loan portfolio. We build better loans, more resilient loans, and protecting them against the leading causes of default, job loss, and disability. So what's on the screen now is a couple of the benefits that Payment Guard does. It helps to differentiate loans because as loans go online, they become commodities. We've heard from consumers who are shopping online for a loan through Credit Karma or NerdWallet, they look at rates. So we found a way to differentiate a lender's loan when those loans go online by offering this type of protection. We help to build, as I mentioned, more healthy loans, a better, more resilient loan portfolio that's protected against the leading causes of charge-offs and defaults, job loss and disability. And in addition to that, we're helping to expand lender confidence by expanding underwriting. So we're helping to make loans more accessible to more people with this solution. And there's a couple other benefits as well. We're reducing collection burden, making staff more efficient, we're adding value to a lender's business. And last but not least, it's really a lightweight product in the market. No API integrations, a couple of weeks to get up and running. We built this product for digital lenders, fintechs first, and are starting to expand this product solution out now to more of an indirect portfolio for credit unions and other financial institutions as well. We're hearing that similar concerns about rising delinquencies and charge-offs, and we are starting to see some early traction with this product being helpful for those portfolios. So on this slide, what we have highlighted is a couple of the stats since we've been in market. So we launched with Payment Guard in January 2023, and since then, we achieved what we said we would go out and achieve. We helped to reduce delinquencies and charge-offs. What you see on the screen here is a 29% reduction in defaults, and we're leading towards a 20% reduction in charge-offs. So significant savings to the bottom line. Secondly, we're helping to improve conversion rates. Some of the lenders in our program have improved their conversion rate by over 190% month over month since adopting this product because it helps differentiate their loans in an online commoditized environment. And last but not least, what's on the screen on the left-hand side is a chart that from a recent white paper that is done by Cornerstone Advisors, analyzing this type of insurance protection, embedded loan insurance, what impact does it have on a lender's portfolio? And what they did is they analyzed through a 5-year model the financial performance of a 20% reduction in charge-offs. And for a high growth lender, let's use an example of maybe 10,000 loans a year with a default rate of around 1.6%, a 20% reduction helps to save for every $42 in charge-off costs for $1 premium. So $1 premium, that lender is saving $42. So significant impact to the bottom line. We're happy with the results that we've seen so far in market, and we're looking to expand in the years to come. And if you're interested in learning more about the white paper that I mentioned that was authored by Cornerstone Advisors, you'll have access to it on the Docs tab, Documents tab of your screen. And now we'll pause for a Q&A.